You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome back to the Options Insider Radio interview series here from the scenic and sunny Options Industry Conference. This year setting down in beautiful Palm Beach, Florida here, and we are joined next up in the Southern studio by a newcomer to the program and indeed to the network. He is Dave Barrett, the head of options strategy at Nasdaq. Dave, welcome to the Options Insider Radio Network.
Thank you very much, Mark. How are you?
I'm doing great so far. It'll ask me in a couple of days if I still have any voice left, if I've been doing this for 2 or 3 days, and it might be a different story. But right now, I'm doing great. Dave, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give us a bit of an overview of your background in the world of options, as well as what the head of option strategy does day-to-day over there at Nasdaq?
Well, those are very good questions. My background is I was an options trader on the floor of the CEC, trading coffee options starting in 1996.
You don't get a lot of guys starting in the coffee pits.
Yeah, that was actually a wild introduction to options trading, as coffee it was a fairly skewed product in terms of its price distributions. From there,
here to be trading coffee again, I think. Right?
Yeah, it afforded a lot of opportunity, and people did very well. But as far as a steady stream of income, it presented challenges because it was either feast or famine. So in 2000 of October, I moved to the Amex to trade QQQ options, and did so through 2006.
A little bit more liquid, pun intended.
Yes. No, and it's sort of a much more intellectual pursuit on some level. Much steadier stream of trades going on where, again, coffee was feast or famine. QQQ was the most liquid product in the world at the time, or certainly in the United States. And after, as Amex volumes waned from electronic trading, of which it was at the time very poorly positioned, I started hunting for positions for electronic trading firms. I joined XR Trading in 2009 and was a senior trader there, and then became their head of index options trading in, I believe, 2011, and had that position through May of 2024 when I joined Nasdaq.
All right, well, let's not bury the lead. I have some other questions I was going to talk about, but you folks are the bells of the ball at the conference this year. Everyone wants to talk about Nasdaq because everyone's all fired up about all things zero day. Every year we come down to this conference, certainly for the last couple of years, and our audience has been bugging us. When are we going to get zero-day Tesla? When are we going to get zero-day Nvidia? And the answer is always, we don't know, or maybe sometime in the far-flung future if we can figure out the contra exercise and everything else. And it sounds like you folks are putting some irons in the fire along that front with a new foray on the Mag 7 for zero-day. Tell us about your filing and what you guys are planning.
Well, I think Nasdaq is trying to do this as responsibly as possible, which is to pick a set of criterion that will be for Monday and Wednesday expirations for underlyings that are basically the most liquid in the options universe. And they are the Mag 7 plus Broadcom, which is, I'm hearing the acronym now is Batman for that. So really, we have 4 criterion. The first is it has to be a $700 billion market cap to be in the program. It has, or if it's an ETF, it would have to have $50 billion of assets under management. The second criterion, it would have to have done 10 million sides in the prior month. And so we're going to reevaluate these criterion every quarter for admittance or for kicking out assets that no longer meet the criterion. The third is it has to be a 250,000 lot position limit, as registered with OCC. And then the fourth is it has to be in the penny interval program. So if we look at the securities that we've created, these are the most stable securities, the most well capitalized, and they're certainly the ones that attract the most amount of capital in terms of attention, liquidity in the marketplace. And we feel confident that that the customer is getting a very fair market and that this expansion actually enhances their ability to engage in risk that they wish.
Now, one of the big sticking points around the zero-day equity options was the contra exercise orders. Sure. Market makers wanted to keep them. Other people were dubious about it. How are you dealing with that in this new proposal?
Contra exercise has always been a little controversial. Obviously, it goes back historically to when the SIBO created options and made them American exercise, which, had probably a whole generation of unintended effects that we currently live with today. That being said, we rely on the fact that the investor currently is becoming more and more sophisticated. The data that we see in terms of skate rates, in other words, irrational decision making on the part of a given customer is extraordinarily low these days, and they are engaging in strategies that, to us, reveal just an entirely generational sea shift in sophistication. And so consequently, we believe with a certain amount of education that customers would be able to handle the contra exercise window rationally and engage in the logical decision making necessary to mitigate the risks attached to it.
And are there any carve-outs for exceedingly busy periods like this past week with all the Mag 7 earnings? Is the pilot not going to operate during that time? Or
the pilot we're not calling it a pilot. It's going to be a program. And we are going to exclude any earnings date from an expiration in this filing. So in this filing, if there is a known earnings date on a Monday or Wednesday, we will not list options for one of those securities on the Monday or Wednesday. If that explains your...
Yeah.
You looked at me.
It was such an abrupt answer. I was expecting, layers of nuance.
Honestly, I think,
from a leadership standpoint, we want to move the industry in what we think is a positive direction, where it seems to us that there's clear demand for these instruments. If you do an analysis of sort of the expiries that are traded, and the movement in terms of how far out people are trading, it's clear to us that the customer very much wants to trade in the shortest data horizon that it can possibly get. And so we feel that we're responding in that regard and doing so responsibly.
Now, I know our listeners, they're going to say, we want these in our hot little hands, our trading accounts right now. What are we talking about in terms of time frame for this?
So we submitted our filing, I think on May 1st, if I'm not mistaken. And, that goes through a 45-day review with the SEC, at which point they can extend another 240 days before giving us a final verdict. We have been in active talks with the regulatory agencies. They have the rational expressed concerns that circulated around the industry around the contra exercise window, and we have supplied them with data. And then they come back and they ask for more data, and we, again, accede to their requests. We want to engage them as much as we can. We feel confident that this is the right move for the industry and that it benefits the customer in the long run. But it may take a little bit of time, and that's the nature of, the regulatory agencies.
It does seem like the educational lift on something like this is a heck of a lot easier than what some of the other proposals were. We go for an entirely cash-settled crop of new equity options and then explain to someone why you sold that put in Apple and you don't get the stock. That seemed like a non-starter to me as well. So at least you avoided that.
No, I mean, cash-settled options, are I don't want to say a compelling alternative, but we're not an ill-considered alternative. I think in the end, given the structures that exist, broadly throughout the industry to accommodate the settlement of options, through physical delivery of the security. And sort of the structures that existed around risk, the risk margining, it really, and also implementation. In other words, we did not want to create a whole new series of options where someone had to type in, say, a different asset code to get that particular option, like Nvidia, NVDAC, which would be cash out. We wanted to avoid that complexity, and because we felt it would be unnecessary, and frankly, it could cause even bigger problems than the solution it was being proffered for, right? Which is, I mean, a perfect example is if, let's say, you bought a Wednesday cash settled option and you thought it protected you through an earnings, and then you were unaware of that. That would be a horrible outcome, because you thought you have the exercise capability through the earnings, but in fact it would be cash settled. So ultimately, we landed on the decision that the American exercise options that we all know well and that we all trade and that the industry seems very confident in is the way to take the customer. And I think the customer's behavior indicates that they can handle it.
Well, outside of 0 day, which our audience is rightfully obsessed with, you're joining us at an interesting time. We just have the numbers coming in for April, a hot month, go figure. A trade war, all it took was a global trade war to drive some volume.
Yeah, that'll do it every time.
Yeah, total volume up 24.3%, just bangers across the board, with the exception of VIX futures, down nearly 5%, which is odd that they didn't catch fire last month. But this is our first time really chatting with you. This has kind of been an ongoing discussion point we've had with a lot of the different folks at this conference over the years, the notion of, can this volume trajectory continue? And I don't mean specifically this is probably an outlier. I don't expect us to be up 24%.
I think everybody understands that April was a very special time. That being said, this industry is going to continue to grow for a whole host of reasons. Wealth is accumulating naturally throughout the United States and the world. The United States is the innovation engine of the world, and because of which we see wealth increasing, and the need for risk instruments to diffuse risk and to hedge or to use this for vehicles of speculation grow, and they grow naturally. And that's why you see volumes just naturally accrue over time. What is interesting to me is most times people attach a linear growth to this industry, and in fact, I think if you look at it, the growth is a little bit above linear. It's a little parabolic, frankly, not on the order of an exponent to the squared power, but to like 1.1, 1.2. In other words, this industry is going to grow, and it's going to grow in a nonlinear fashion. And I think, part of that growth will be the rational listing of instruments to accommodate the demands of our customer base.
Now, last year at this conference, out of the blue, people, especially on the exchange side, became very excited and wanted to talk quite a bit about Flex. I dubbed last year kind of the stealth year of Flex. Yeah. Transform and fast forward into 2025, and everyone's still obsessed with Flex. Yep. Why is Flex so hot in 2025 for you guys?
So, I mean, Flex interest had always been growing to some degree, correct? What happened, obviously, at the mid to tail end of the Biden administration is the need for interest rate growth. Short-term interest rate growth so all of a sudden meant balance sheet and financing concerns for securities. It became a very serious concern. And Flex options allow for engaging in European transactions. In other words, where a financing on a forward has to be to do a financing transaction, which would be a reversal conversion institutionally. This is going to get really arcane. One would prefer to use a European option because one wants a fixed date for expiration. No pre-exercise risk, effectively. So you saw Flex grow on top of its normal growth as an outgrowth of rates going from the low 50 bips, 100 bips, all the way up to 4.5%, 5%. And that was to be expected. But what has also occurred is you have a whole host of securities that are, a tailored return or structured ETFs that are seeking some type of structured return, not necessarily a linear return relative to the underlying asset. And that requires optionality as well. And the managers of those asset classes, the managers of those ETFs, very much seek bespoke optionality. They do not want to go to the standard options market and try and buy an option or sell an option that closely rivals their tailoring. They want the exact option that gives them the tailoring they desire. And so those two factors, the increase in interest rates and sort of the growth of ETFs that have tailored returns, are really driving flex growth. And Nasdaq recently, as April, instituted sort of its electronic flex implementation.
And how's that going so far?
Well, we're just in the nascent stages. So we believe we're getting a lot of positive feedback. We're still basically in the phase where we are trying to get customers to test with our APIs and connect to us and start placing their order flow through our markets. I think it's a great innovation on Nasdaq's part in that this is going to allow for the placing of orders or paired orders through a fixed implementation. So there's not going to be any manual interaction whatsoever. It can be fully automated on some level.
This time a year ago at the conference, there were a couple of things everyone was all excited about. One was 0 day. The other thing was the looming prospect for Bitcoin options. IBIT had been approved in the beginning of the year, then no one knew how long it was going to take for the options to launch. Most everyone at this conference a year ago, with the exception of Sean, who pointed it out to me when he was here earlier, who was here for Nasdaq last year, he was one of the only ones who was optimistic on the prospect that we would even see Bitcoin options last year. Almost everyone thought it was far in the distant future. As we all know, they came around in November and have taken the options world by storm as a result. So first off, what are your thoughts on just the resounding success of IBIT? And then B, do you think there's another product in the offing this year at the conference that could be the next IBIT that takes the options world by storm, maybe this year or next year?
So, I worked very closely with the Office of General Counsel at Nasdaq to do the IBIT filing, and it became very clear to me, as one of the proponents of it, that this security was plenty liquid enough, and the asset that's supporting it was unbelievably large, that the concerns that had been expressed by the regulatory agencies around potential manipulation or what should the position limits be were just not founded once the data would be laid out. And they completely sort of agreed with our filing, and that's why we ended up being able to push through IBIT. And I thought it was a great victory for Nasdaq in that regard, getting IBIT options over the finish line. IBIT is sort of the fundamental contract that sort of U.S. Bitcoin options trading is now being founded on. And the biggest stumbling block into expanding that is really just there's currently a 25,000 lot position limit on it. And we're hearing from all sectors, from the hedge fund side, from the market making side, that it's simply not adequate enough to tailor to their needs. So we have a filing currently to expand that to 250,000, which would bring it in line with GLD and SLV. Bear in mind that IBIT itself as an asset, has an AUM above $50 billion. And the underlying asset is very close to $2 trillion. If it's not already above $2 trillion, I'd have to check. So, we're talking about one of the most liquid assets on the planet right now. And I think our push, especially with respect to trying to, draw the industry in a positive direction, is to try and push forward on that 250,000 lot position limit increase, which will facilitate dramatically more trading in our mind. When you think about from a customer's concern, there are a whole host of places customers and their proxies, hedge funds, can get this risk. And really, I think it's in everybody's interest to have that risk onshored. In other words, to be under the U.S. regulatory scrutiny, as opposed to being traded somewhere abroad where the same kind of scrutiny is not necessarily applied, where the same financial regulations don't necessarily exist. And so the protections, I'm always of the view that the protections that the U.S. regulatory system offers the customer sort of demand that the expansion be done. Otherwise, customers will find another vehicle, and it will be a less preferential vehicle from a regulatory standpoint than if it's onshore in the U.S.
Did you ever imagine when you were pushing through that application back around November that we'd be hitting 500,000 ADV and sustaining it for the better part of this year? I mean, I know that surprised a lot of people.
If you looked at the sum of Bitcoin trading, I don't think it was that surprising. I think that's kind of where we envisioned. We had several calls where we were trying to lay out. It was first a nickel. It was a non-penny product, so the ADVs were a little bit lower. It went to a penny product shortly after its inception, I think in January, and it started hitting these ADVs. And I think with the position limit increase, it could easily eclipse 1 million, frankly.
Yeah, raise those limits. That'd be interesting to see how much it can grow. Well, one of the things we're talking about this year as well, Dave, we had a well-known options educator, a good friend of our network, Alex Jacobson, passed away over the weekend. He did work at ISE back in the day, one of the umbrella exchanges over there at Nasdaq. And kind of in his memory, we're kind of doing a little bit of a poll on the state of options education, especially right now in the business. Nasdaq obviously owns 6 exchanges, so you have a lot of skin in this game. I'm curious from your perspective, what are your thoughts on the state of overall options education? And then B, Nasdaq as a very large exchange group, what do you think you guys could do to further that goal, especially as we're seeing so many new entrants come in, 24% just in April. So a lot of new players coming into the game.
Absolutely. I think the new players coming into the game is the recognition of the value proposition that options currently offers, right? You're getting penny-wide markets in the most liquid securities, or options on the most liquid securities. And when you contemplate what that leverage is, in other words, how much, if one considers one has to pay to enter or pay to exit a given trade as half the bid offer width, that cost from a value proposition is extraordinary. I mean, think about a penny-wide market on the SPY. The SPY's probably trading north of $600 right now. I'd have to check, but so you are paying half a penny to be able to leverage a $600 asset. It's really quite incredible the efficiency that customers are getting. It's a continued mission of all participants in the industry, not only Nasdaq, but the brokerages and sort of the industry institutions, to responsibly educate the public about exactly what these instruments are. And I think you can find a number of different venues where you get a very good education. It's astonishing the amount of information that's out there. I don't know if that adequately answered your question.
Do you think we need to go back to the days when the exchanges had educational staff? I mean, I think about it right now. I think the only one that's left with any sort of educator is the SIBO with the Options Institute. The days of, exchange educators seem to be behind us.
Well, for starters, I think that largely the brokerages have taken over that role to a large degree. I don't foresee us having an education outreach. But that being said, Nasdaq does do outreaches where we talk to various groups, and we're always willing to have a conference or speak at any conference for that matter.
Well, Dave, I appreciate you taking some time out of this conference to join us here today. Before we wrap up, we'd like to leave our audience wanting more. Obviously, the 0-day one is a big one to look forward to. But aside from that, any other hints, any other teases, or any other interesting things you folks are working on over there at Nasdaq you want to share with our audience? Now is the time, sir. The floor is yours. Right now,
so our big implementations this year are going to be the single stock daily options, our Flex offering, and we're trying to engage in something probably a little more weedy for your clients, which is options regulatory fee reform. So those are I think, our big initiatives currently, and that's where I'll have to leave you. I have nothing.
Fee reduction is not sexy, but at the end of the day, everyone gets excited to pay less, right?
That's exactly the point.
No one wants to hear it. Then they look at their statement like, oh, I don't mind a fee reduction at the end of the day. Well, Dave, I appreciate you joining us, and we'll look forward to seeing how all these initiatives, in particular, I'm sure the 0-day, you're going to be hearing a lot from our audience on that, how that unfolds in the marketplace in the coming months.
Thank you very much, Mark. It was a pleasure talking with you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.